Hello everyone! Welcome to another episode of Spot and Forward. My name is Martina Fraschini and I'm an assistant professor of finance at the University of Luxembourg. Today, I'm honored to interview Christian Pfister on behalf of the Luxembourg Financial Market Association. The topic is central bank digital currencies, or CBDC. Christian is now a consultant in digital currencies for financial institutions, including the IMF. Christian, thank you for being here and welcome to Luxembourg.
Martina, thank you very much. It's my pleasure to be here at the invitation of LFMA. I particularly wish to thank Vincenzo for this invitation.
Central bank digital currencies would be a digital form of money issued by central bank and available to everyone for electronic payments. To better understand the implications of central banks issuing CBDC, could you explain us which role central bank digital currency will play in the economy?
Thank you for your question, Martina. There are two forms of CBDC playing two different roles. One form is retail CBDC, so-called digital euro in the case of the euro area, with which you can draw a parallel with banknotes. It would be available to the general public. There's also wholesale CBDC that would be only available to banks, just as reserves are now. They have characteristics in common. Inter alia, they are both issued by a central bank and they circulate at par, meaning €1 as a retail CBDC can be exchanged against €1 as a wholesale CBDC or as reserves or as banknote. In both cases, CBDC brings safety in transactions. This could be particularly useful in financial crisis. And it's also particularly useful in wholesale transactions because the central bank money provides the final means of payments between banks. In more normal circumstances of financial crisis, a retail CBDC could also help by preserving a link between the central bank and the public in case the use of banknotes were to dwindle, as it has already begun to, at least in transactions. Less clear would be the contribution of retail CBDC to financial inclusion, which is already very high in developed economies, and its contribution to innovation would very much depend on the conditions at which the retail CBDC is provided. That is, I'm referring to the range of services that will be provided by the central bank and by the pricing of these services. In case these would be set too low, then there is a risk of crowding out private sector innovation. Finally, the internationalization of the currency could be promoted by the wholesale form of CBDC in particular. There are benefits to issuing a reserve currency, but it's not clear in the case of retail CBDC that there would be a prime mover advantage to the first issuers of such a form of CBDC. In any case, authorities are very present in that field for, I think, very clear KYC reasons. A difference which is important between retail CBDC and wholesale CBDC is that retail CBDC doesn't necessarily use DLT, distributed ledger technology, whereas wholesale CBDC would have to in order to differ from reserves which are currently available.
So the ECB has moved to the preparation phase to develop a potential digital euro, while the Fed is still in the discussion phase, and it looks to me that is more cautious in its statements. Do you think that the ECB is moving too fast, or is the Fed too slow?
I'd like to stress first that central banks have to proceed cautiously for two reasons. The first one is that they cannot afford to run certain risks, the risk of cyber attacks, for instance, or the risk of the use of CBDC in illicit transactions. The second reason is that they must get the active involvement of the private sector for CBDC to be a success. Second, I have to stress that the context is different on the two sides of the Atlantic. There is an electoral campaign in the US with one candidate who has declared he was very much opposed to a digital dollar. And both candidates are much more vocal about cryptocurrencies than about a possible digital dollar. In Europe, in fact, during the elections to the European Parliament, crypto assets were hardly mentioned, and the prospect of a digital euro was not actively debated. However, differences should not be overplayed. Just as the ECB, the Fed does experiment on CBDC, although the focus in the US is more on the wholesale version, whereas it's been so far more on the retail version in the euro area. Both central banks have made it clear that they would launch a CBDC only if this initiative is endorsed by law. So there are similarities. And both in the US and in the euro area, surveys show that the public is more concerned about the access to the transactions by big tech firms than by the government. So the insistence in the US on the government not having access to the private transactions data seems to me pretty overplayed.
What are the consequences for liquidity? Will the impact be positive or negative?
So I'll talk first about retail CBDC and then about wholesale CBDC. Regarding retail CBDC, there are some academic papers which show that by fostering financial inclusion, a retail CBDC could lead to an increase in deposits. However, financial inclusion would need to be low to start with, which is not the case in most developed economies. So most likely, retail CBDC could have a negative impact on liquidity in the banking system. Retail CBDC should substitute for other monetary assets, especially cash and sight deposits. However, the substitution for deposits is likely to be more rapid and stronger. The first reason is that retail CBDC is more similar to deposits than to cash. It is digital, it is a means of payment just like deposits and cash, but cash preserves privacy better than deposits do, and thus as retail CBDC could. Second reason is that use of means of payment is largely determined by habits. The users of cash in payments are in large part seniors who do not change their habits very easily. However, substitution would not necessarily be an issue. Retail CBDC would be exchanged by banks for reserves, which are low-yield assets in banks' balance sheets. For instance, in the euro area, banks hold around 3 trillion euros in excess reserves. This represents 60% of overnight deposits held by households, even supposing that all euro area population, that is 350 million people, were to hold 3,000 euros in digital euro. This would imply an uptake of only, so to say, little more than 1 trillion euros. In the opposite direction, if banks wish to rely on central bank money to fulfill their liquidity requirements, a retail CBDC could at times complicate banks' treasury management. Regarding now wholesale CBDC, a priori, WCBDC would substitute for reserves and thus not impact on the liquidity of banks. However, much will depend on whether netting and queuing arrangements, which are currently used to save liquidity, are also available in the DLT environment before final settlement in central bank money takes place. The issue is very similar to the one faced in the 1980s, 1990s, when central banks built their real-time gross settlement systems. One can also think that if liquidity saving arrangements are not available on the blockchain, this could restrain transactions in tokenized assets and eventually might hamper the development of tokenization itself and the use of wholesale CBDC itself.
Central bank digital currencies will be, at the end of the day, liabilities of the central banks. Keeping this in mind, do you think that issuing a CBDC will interfere with monetary policy?
Regarding first the monetary policy strategy, the interference would be nil in the case of central banks targeting price stability. However, there could be a possible interference in economies which target the exchange rate or a monetary aggregate. There would be no interference either with the monetary policy transition mechanism. In the case I rule out, that is of the possibility of the central bank using either the interest rate on retail CBDC or the volume of retail CBDC as a separate monetary policy instrument, as envisaged in some academic papers. As I think this would be confusing, and it could lead also to a break of parity between the different parts of the monetary system. WCBDC would have to be remunerated at reserves, at least if, I'm going to tell you in a moment, the full possibilities of DLT are used by the central bank. There could be there's an interference with the monetary policy framework. In the case of retail CBDC, as already mentioned, retail CBDC would have to be exchanged against reserves by banks, and this would absorb liquidity, potentially implying more liquidity provision by the central bank to neutralize. In central bank's jargon, retail CBDC would be another autonomous factor of liquidity. Accordingly, the gyrations in the demand for retail CBDC could create extra volatility in the volume of liquidity and possibly warrant intervention of the central bank in the money market to supply or restore liquidity. Regarding WCBDC, you can differentiate two extreme models for this adoption by a central bank. In case the central bank wishes to make only a restrained use of DLT possibilities, the monetary policy framework could be basically unchanged. That is, DLT would be used mainly for notary purposes, with central bank validating transactions. WCBDC could be created only by transferring reserves onto the WCBDC platform and destroyed by converting WCBDC back to the reserve accounts. This WCBDC platform would operate only during central bank working hours, and WCBDC could bear a zero interest rate. In the case the central bank would wish to make an extensive use of DLT possibilities, then WCBDC could be created directly onto the WCBDC platform, for instance, by purchasing assets or by conducting refinancing operations. The WCBDC platform would operate on a 24/7 basis, so an explicit market for WCBDC might develop. At some point, this could lead the central bank to also operate on a 24/7 basis. Finally, giving access to non-banks, for instance, private payment service providers, or to non-residents could be envisaged. Note, however, that many of these changes do not presuppose the issuance of WCBDC. For instance, the Swiss National Bank already gives access to non-resident banks. Rather, WCBDC would provide an opportunity to implement such changes.
And to conclude, do we really need a CBDC?
A short answer would be no, but of course there are nuances. Regarding WCBDC first, WCBDC will only be useful if the tokenization of financial assets takes hold, and DLT still has to show it clearly outperforms existing systems. Also, there are alternatives to the use of WCBDC and even to that of central bank money, although they do not provide as much safety. These include using stable coins, tokenized assets, or tokenized money market funds. A link between central bank money and the blockchain universe would also be feasible without launching a CBDC, a WCBDC, using an alternative such as a trigger solution. Such a trigger would build a technical bridge between the central bank's RTGS, real-time cross-settlement system, and the asset chain on which tokenized assets are traded and settled. However, this solution could prove cumbersome at some stage if asset tokenization takes hold. Furthermore, issuing a WCBDC could help foster asset tokenization, modernize financial markets, facilitate cross-border payments, and promote the international role of the currency. Regarding retail CBDC, in developed economies, we have a high degree of financial inclusion and well-performing and reasonably cheap payment services. In these economies, the risks of the dollarization of the economy by stablecoins or foreign CBDCs can be considered as minimal. Things can be different in some emerging or developing economies, although issuing a CBDC is no silver bullet against dollarization, and there are also other ways to foster financial inclusion, with M-Pesa in Kenya, for instance, being a very famous example.
Christian, thank you once again for participating and sharing your knowledge and experience with us.
It was my pleasure, Martina. Your questions were very much to the point, and it was a real pleasure to answer them.
And for those of you watching online, stay tuned for another episode of Spot and Forward.